It's one small step for man, one giant leap for mankind.
Welcome to The New Next, a podcast that addresses current events and how they will impact the future. So you do a lot of like private investing that you and I talk about that in private and accredited investing and stuff that's not typically your mutual funds that most people look at, whether that be kind of private real estate deals or venture like growth deals, syndicate opportunities, stuff. What kind of stuff do you like to look at for investing? What's been piquing your interest lately? And maybe you could tell us a little bit about that.
Sure, absolutely. I think the direction we were talking about taking this conversation is the difference really between what people typically think of when they think about investing. So stocks and bonds that you can, buy from your broker online, that you can watch the price traded and understand the public financials. We've talked about Disney. You can go look up their ticker symbol, DIS, I think it is, and get a good picture of what's going on with them quarter to quarter. And that's, what most people think of and have in their 401k, or maybe you are curious about it and be able to research that. Really, I think, the direction we're taking this conversation is looking more at the private markets, like you mentioned. And so, that really is, a really wide range of types of investments in private companies through things like angel investing, venture capital, private equity, hedge funds, and real estate as well. I've been around this for a long time. My first job out of college was with PitchBook, doing research on private equity deals and trying to understand and find all the information on these things because they're not public. And really, this is a whole sector of our kind of financial economy that there's a massive amount of money in. There is a massive, it funds and drives a lot of the companies, especially early on in our economy. But it's not widely understood, and really, that's an access and privacy driven. Because there is no requirement to put that information out there. So, just in the last few years, I've really started to dive more deeply into it in a more active way. With my background in technology and early stage companies, it's something that I feel like I have a little bit more knowledge and ability to learn about, and access to folks building early stage companies. And I also just find it really interesting, understanding how these deals work, and all of that stuff. And so, personally have been wading into, early stage angel investing, talking to early founders who are still trying to find product market fit. And then also just other things like, completely different, like real estate. There are multifamily, apartment buildings and things like that all over the country that are being bought and sold all the time, that are being improved upon, trying to make them more attractive to renters and things like that. All of that private capital is something that it's really curious to see how it all works.
Yeah. And you probably agree that in private investing, so private investing has basically a exponentially less legal requirements in the markets that Joel's talking about than like mutual funds and stuff like that. So there's an assumption, because you have so much money to invest, that you have some sophistication with you and that you're accredited and you have the money and the knowledge to do proper due diligence on the investments. So I would say that there's a lot of kiss a lot of frogs before you find a prince sort of things. Like, Joel's always talking about different potential deals with me, and then kind of going down into the market stuff, and then also looking, every deal is priced differently. So you may be hot on a company, but you just don't see, the cash return or the investment return potential in the deal or compared to other investment opportunities that you have. So yeah, it's pretty interesting.
In terms of, you mentioned accreditation, I mean, just talking about how you can even get access to this kind of stuff. And you mentioned essentially there's like a multi-part test for whether or not you are legally allowed to get to, participate in these types of deals. And it's what would be called an accredited investor or qualified purchaser, which is the level above that. And really, there are more than this, but it's either based on your total assets, your income, or, certain types of certification. So if you, have more than $1 million in assets, not including your primary residence, or you make more than $200,000 a year, or you've passed, I forget what it is, maybe the Series 63, or you represent
66.
66, okay. Yeah. Essentially, this is all kind of a rough test of your sophistication. Do you have the ability to understand these investments, understand the risks in them, because they are more risky. And we can get into a little bit more, but essentially there's a lot of gatekeeping going on, trying to, the SEC is trying to protect people from being, going into frauds or things like that, make sure we protect your money. There's a big debate about whether or not that quote unquote sophistication test really tests whether you're sophisticated or not.
It definitely doesn't seem like it a lot.
That making a lot of money doesn't necessarily make you smart.
Yeah, definitely not.
And so, there are changes in the laws too that are coming out. That are allowing more folks to be able to participate in this. There's the Reg CF, which came up several years ago, that allows private companies to do crowdfunding, CF crowdfunding. And so, bringing more people into these types of investments at the early stage, or at any stage really, but allowing people who don't necessarily meet those bars to still be able to participate and in this area that's kind of been reserved for the kind of richer folks in the country, which is it has its pros and cons, because of the risk profile, but also on the positive side, you get to participate, and that's fantastic. You mentioned the returns too, or kind of the risks involved with it. One of the kind of common phrases you'll hear for venture capital and others is power law returns. That the risk is high, especially for early stage, and so 90% of the companies that are going through this process will probably fold and close up. It means your investment goes to zero, and so you really do have to work to build a portfolio, build a fairly large portfolio to make sure that you do find that 10% that supplies you with enough return to at least get your money back.
Which is a totally different scenario than like real estate, fixed assets, or what typically is done in private equity too.
Yeah, or even public equities, right?
Yeah, definitely.
A basket of stocks, you're not expecting 90% of the S&P to go to zero in the next 5 years. Those are stable companies with product market fit, and their price might go down or up, but they won't cease to exist. And so it's a very different type of investment area, and it kind of requires you to think a little bit differently about how you build a portfolio and evaluate these companies. And finally, you talked a little bit about price too. With a stock, you can look every day and see what its price is. It goes up and down every second, based on how the shares are traded back and forth, and what there's price discovery there by how the market decides what it's worth, and based on the information that they can get publicly. For these, I mean, these companies are priced maybe once a year. Really, priced when they raised a new round of capital. So, for venture capital, you'll hear they talk about like a seed round or a Series A or B or C. These are discrete rounds of funding where they raise, $1 million, say, and they use that money to go, run their business, try to grow it, and things like that. You don't really know what the price of the business is until it hits one of those milestones again.
Yeah.
And so, and if you're on the outside and you're not running that company and somebody is trying to offer you, a stake in that, you can start to gather information on what their product is and get some financials from them and try to run some models around, whether that seems like a fair valuation or not. But, at the end of the day, because it is kind of an early stage thing, you're taking a lot of
you're betting on the
go ahead.
you're betting on the company, but you're also betting on your kind of personal investment thesis and your ability to source and evaluate good deals.
Yeah, and this is not a liquid asset class. You can't sell your stock tomorrow to somebody on the street because you don't think it will grow the same way going forward. So you're thinking and you're modeling out a lot farther, because the liquidity point traditionally has been an IPO to the public market or a private sale to an M&A transaction to another company, a private equity firm, or something like that. But you don't have an exit until something like that happens. There are other things like secondary sales that allow some little bits of liquidity, but traditionally it's the IPO or M&A route. And so you really do have to think much longer term about how is this going to grow in the future, and fit it into that kind of power law return as well. That unfortunately, getting 5% return on it year over year, 5 to 7 is great in the public markets, but if you're in the privates, if 90% of your investments go to zero, you can't rely. You need things. You need to look for things that are going to be, growing aggressively, doubling, tripling, 10x, 100, 1000x, in order to cover the rest of those losses and also provide you with a return over time. With a 10-year horizon on some of these funds, I mean, you need at least total portfolio growth of at least 7% just to double. And so if only one or two of those investments is supplying that total return, it really does mean you have to think very clearly about what that future trajectory of that company is going to be and whether the valuation you invest at will allow you to get there. If you purchase a company at $10 million and you can see a path where it goes to $1 billion, cool. That's a big 100x return, right? Alternatively, if you're investing at 500 million, it's a 2x return to go to $1 billion. You're not making you're not able to make the math work for something like that. So you have to take that into account, even as much as you might be excited about what they're doing.
Yeah, just a quick note on something that you said. So you talked about time horizon for VC for being 10 years. In some cases, they're talking about 15 in some of the funds that they're raising recently. Private equities, usually 7 years. So when they go out and they're like, hey, institution, hey, bank, or hey, pension fund, or hey, foundation, give me your money. They're basically saying this money is going to be locked up for 8 to 10 years or 10 to 15 years for venture capital, 5 to 7 or 7 to 10 maybe for private equity. So they have to time their deals. So if they fundraise and they've got a 7-year time horizon, that first year is spent, year and a half is spent basically sourcing and completing deals. And, throughout the life cycle on that, you're either using your leftover capital to help support portfolio companies and growth stuff, doing additional rounds or providing debt. But you're really looking, still that goal is in 6 to 7 years from investing in this company, I need to have cash in my account to pay these investors back with some level of return. And if you're talking about venture, you're like, well, I'm investing in 10 companies, 9 of them are going to go bankrupt, but this 10th company is going to provide me that amount of cash at that time where I'm going to be able to pay a basically a 20%, 30% compound annual return on that money that the institutions gave me on the outset. It's very, very complicated. In recent years, everybody looked really smart because the market's going up and up. But I think being a good investor, timing the time horizons like that, making your institutions happy is a good thing. Because if you look at who's the guy, the Big Short guy, Michael
Lewis.
Yeah. Not Michael Lewis, the investor guy. Michael Burry. Yeah. So that's a kind of a cultural example of that. Michael Burry was right. He made boatloads of money, right? But his institutions just told him to F off after that whole experience because he locked up their money and didn't play by essentially the rules that they had set on the outset. So it's not all about making people money. It's about having kind of that institutional risk factor and that, I guess, strategy there too. And really timing the investments, because the institutions too are also managing their own portfolios in the same way that.
Yeah, and on the time horizon you mentioned, even 20 years ago, the time a company would take from inception to IPO, it's been getting longer and longer and longer. So this is not the reason these things are 7 to 10 years, and Matt said they're pushing into 15-year funds is people are staying private longer. There are positives and minuses to staying private, but it used to be that maybe you would start and spin up and you would go IPO or sell in 2 to 5 years, and that would be great for a 7-year fund. But companies are staying private 10 plus years, and so even if you have thousands of employees, they all have private stock and they can't sell it. So it's like it's for the business, maybe it's a great way to grow and kind of grow without the overhead of public reporting and all that kind of stuff. But it has drastically changed how people build portfolios and things like that. And in terms of the institutional investors, pension funds and things like that, you mentioned, even right now where we have the market going down, the public market going down, a lot of those places are asking these funds that they don't reprice their company until a new round. To actually go and mark to market, to reevaluate their portfolios. And from a fund perspective, you prefer not to do that. It makes it look like you're losing money, you're down when those companies are continuing to grow, and in the future will probably, who knows, maybe be successful. But from a portfolio construction perspective for the institutional investors, they're now massively overweight on these private things, even though, because the public equities reprice and they go down, and it's like, well, they can't put any more money into this area, even when from a market perspective, it's a great time, if you have capital to put it to work. The prices and the multiples have come down. Maybe we'll continue to be kind of in this recessive state for another year or two. But this is when things get built, right? This is when people really, everybody that is leaving Amazon and Twitter right now, what are you going to do? Are you going to go build something? Are you going to, it's a great opportunity to find great deals. And
definitely,
if we look at the 2008 and 2007, crash and recession, the quote unquote smart money actually stayed out for way too long. And so, but it requires people to kind of suck it up, reprice stuff, be realistic about, what's going on and make some smart decisions. So,
Yeah, I think, like, to your point, we used to have a lot of regional stock exchanges and like Northwest, stuff like that. So you'd see a lot of companies IPO at a $40-50 million valuation because they needed the capital. And like, my brother Eric he's director at Silicon Valley Bank, and they basically, or they're publicly traded now, but they started their niche thing with this venture debt investing. So they would provide debt capital, oftentimes along with financing rounds for companies, where it'd typically be more equity. So debt capital and also warrants, where you provide debt capital that pays you money, but that debt is convertible into common stock in the future too. So they evaluate, they've kind of filled this niche for that capital need from, kind of your mid-series level investing level towards IPO, that's allowed people to basically extend, work more on kind of like, I guess, gestating their baby, so to speak, leaving it in the womb a little bit longer. I don't know what to say, before it gets out there and really goes. Because from an investor sense, up until recently, you'd typically eventually go to market and then get a higher multiple. So you'd capture more of the upside while it was private, and then also get a bigger bump once you actually like went to markets. But I think SoftBank, with just how much money that they had in recent years, really fragmented a lot of the markets. And you have companies like Silicon Valley Bank and other venture companies that have had still been really prudent investors and not got fully caught up in the hype, that are doing really well. But there's a lot of people that got caught with their pants down, so to speak, So, but it's interesting.
One thing I would step back to and talk about is why this area. I mean, you talked a little bit about, kind of high risk, high reward for this. But I'll also point out too, like, a lot of these things tend to not be correlated as strongly with, other types of investments. And so, like, if you have all of your money in the stock market, well, right now, the stock market's going down. It doesn't matter how good your company is. It's all going down. And it, don't sell everything. It will, eventually go up. The stock market goes up on average over time. But, there are opportunities for things that do not move in the exact same way. And so, there are, like Matt pointed out, real estate, some real estate's going down, but, there's a massive housing shortage in the country. People need
still pays every month.
Yeah. This, generates income from rent, and there's still growth overall from the property being valuable over time. There are other types of investments where there are people who invest in litigation, they invest in in debt and other things like that that are not correlated with these parts of the economy, and so the kind of alternative stuff that we're talking about under the broad umbrella today, it really allows you to diversify into something that will not move in the exact same way as different parts of your portfolio. So you'll have a big chunk in stocks, but you might also have it in something that goes sideways or just continues to yield a nice healthy percentage every month, which makes it smooths things out a little bit more, which reduces your nervousness and worries about what's going on in the world.
If you would like to learn more about the New Next podcast, find us at thenewnextpodcast.com, where you can suggest a topic you would like for us to cover. If you enjoyed what you heard, share the podcast, tell a friend about it, or rate us with 5 stars.